97% of traders lose money in their first year. Look at this. You're watching your account bleed red as Bitcoin drops from $68,000 to $42,000. That stings. So what separates the few who make it from those who don't? One big piece is the 2% rule, a guardrail that stops a single bad trade from wiping out your account. If you're ignoring it, you're taking on serious risk. But how does it actually work, and why do so many traders skip it? Why does risking only 2% of your account per trade make such a difference? Picture this. You're at a blackjack table with $1,000. The rule is simple. You can't bet more than $20 per hand. At first, that seems like a tiny wager. But the beauty of small bets is their staying power. You can endure a losing streak without running out of chips. Now, let's bring this idea into the trading world. The 2% rule is essentially the same principle applied to your trading account. Here's the deal. You never risk more than 2% of your trading capital on a single trade. If your account is $10,000, the most you'd risk on any one trade is $200. Why 2%? Because it offers a balance between protecting your account and staying in the game long enough to let your strategy work. Imagine the market turns against you 5 times in a row. If you're only risking 2% each time, you're down 10%, not wiped out. This rule isn't just about minimizing losses. It's about using the market's natural swings to your advantage. With smaller risks per trade, you have the buffer to analyze, adjust, and improve your strategy over time, without the pressure to recover from massive losses. Traders often skip the 2% rule because of impatience or the urge to win big quickly, but sticking to it is what keeps you sustainable in the market. So, why do some traders ignore this? Maybe they underestimate the impact of a single bad trade, or overestimate their ability to handle risk. Whatever the reason, the 2% rule provides a crucial margin for error. Next, let's explore how this rule applies in real trading scenarios and why sometimes less is truly more when it comes to risk. Imagine you're staring at your trading screen, pondering your next move. You've done your research, and a setup finally looks promising. But before you dive in, there's a decision to make. How much of your trading capital should you risk on this single trade? Enter the 2% rule. It's a simple yet powerful guideline that helps keep your account safe. Here's how it works. Before placing a trade, you calculate 2% of your total account balance. That's the maximum amount you're willing to lose if the trade goes against you. By sticking to this rule, you ensure that no single loss can cripple your trading account. Let's break it down with an example. Suppose your trading account holds $10,000. According to the 2% rule, you'd risk no more than $200 on any single trade. This means if the trade hits your stop loss, a preset exit point for losses, you'd lose $200, and your account would still be largely intact. But why 2%? The beauty of this rule is its balance. Risking too much can lead to large losses that are hard to recover from. Risking too little might mean you're not making the most of winning trades. The 2% rule strikes a middle ground, allowing for steady growth while minimizing the potential for devastating losses. Now, how do you apply this practically? Before entering a trade, identify your stop-loss point. Calculate the difference between your entry price and the stop-loss price. Then, determine how many shares or contracts you can buy without risking more than 2% of your account. This discipline not only protects your capital, but also builds confidence in your trading strategy. By consistently applying the 2% rule, you create a safety net for your trading journey, allowing you to focus on improving your skills without the fear of losing it all. But here's the twist. Sticking to this rule isn't easy. So how do you maintain discipline in the heat of the moment? That's what we'll explore next. Still with me. Here's the part that breaks most traders. Look at this. Your account is growing. You've had a few winning trades. Your confidence is soaring, so you decide to risk more than the 2% rule suggests, maybe 5% or even 10% on a single trade. You think it's the fastest way to grow your account. Then the unexpected happens. The trade goes south. Suddenly, your balance takes a serious hit. When you risk more than 2%, you expose yourself to bigger drawdowns, peak-to-valley losses during a losing streak. That means it takes much longer to recover. If you lose 10% of your account, you don't need a 10% gain to break even. You need 11.1%, and the math gets worse as losses deepen. It's like swimming upstream with a heavy backpack. Say you risk 10% on every trade. Hit 3 losing trades in a row, and you've lost nearly a third of your account. Now imagine the psychological pressure and the emotional trading, decisions driven by fear or excitement, not a plan, that follows. Suddenly, every decision feels like a make-or-break moment. By sticking to the 2% rule, you limit your exposure, how much of your account is at risk. You protect your capital from catastrophic losses. You focus on the process, not the outcome of any single trade. The pattern is clear. Staying consistent with your risk preserves your mental capital. That's your ability to keep making rational decisions when markets get chaotic. So next time you're tempted to go big, remember the cost of ignoring the 2% rule. Picture yourself at the start of a trading day. You've done your research. You've spotted a promising setup on Tesla. With the 2% rule in mind, only risking 2% of your account on any single trade, you know exactly how much you're willing to lose here. Let's say your account is $25,000. That means you risk no more than $500 on this trade. Now Tesla opens with a gap down. That could confirm your thesis for a rebound or signal the downtrend continues. You plan the trade and set a stop loss at $500 below your entry. If Tesla hits that price, you're out. Your loss caps at 2% of your account. The market opens at 9:30 a.m. Tesla moves against you. By 9:32 a.m., your stop loss hits. You've taken a $500 loss. Here's the key. It's a loss you planned for. Your risk stayed controlled. You still have 98% of your account intact to trade another day. By sticking to the 2% rule, you preserve your capital. More importantly, you preserve your mental clarity. It's easier to make level-headed decisions when you know your exposure is limited. This discipline helps you bounce back. No emotional weight from a big loss. You approach the next opportunity with a clear head. Look, the 2% rule isn't just about protecting your account balance. It's about keeping your composure and staying in the game. So when you sit down to plan your next trade, remember this example. The 2% rule is your buffer against the emotional zigzag. It's how you make sure one bad trade doesn't snowball into a string of poor decisions. You're not just protecting your money, you're protecting your ability to keep trading effectively. You've heard about the 2% rule, but do you actually understand what it does? This rule is about limiting your exposure. That's the portion of your account you're putting at risk on any single trade. You cap that risk at 2% of your trading capital. No single trade can wipe you out. This isn't just a guideline, it's a survival framework. The pattern is clear, the math is simple. If your account holds $10,000, you risk $200 per trade. That's it. That limit lets you absorb a losing streak without destroying your capital. Traders who skip this rule often run straight into drawdown. That's the peak to valley loss, the total drop from your highest balance to your lowest during a rough stretch. It hurts more than most beginners expect. The 2% rule acts as a buffer. It gives you mental clarity when the market turns against you. And it will turn against you sometimes. That's just trading. Real quick, if this is clicking for you, hit subscribe. We get into trading psychology every week. When you build this rule into your strategy, you're not just playing defense. You're laying the foundation for long-term staying power. Discipline is what separates traders who endure from traders who flame out. That's where your trading journey actually starts. Ready to unlock more trading insights? Hit that subscribe button. We're here to guide you through the complexities of trading psychology with practical strategies like the 2% rule. Each week, we break down concepts that help you trade smarter and with confidence. Recognize the setup, seize the opportunity to enhance your trading skills, and strengthen your financial future. Subscribe now, and let's continue this journey together.